Hello and welcome to the Australian Retirement Podcast, all you beautiful human beings. It is a pleasure to be here today on Thursday to talk all things finance. And I have a still surprisingly sniffly good friend, Drew Meredith here. Hello, mate. How you doing over there?
Very well. It's chilly morning in Melbourne. It's been, we're after midday now. I don't think the temperature's gone much above 4 degrees, to be honest. But yeah, there was ice on the windscreen this morning, and there was also ice on the grass out in the park when I was going for a lovely
Come
three
on
and a half
now.
hour walk.
No. Yeah, okay. It wasn't ice on the grass. What you meant to say was ice on the green, right? You're out
Yes,
there
ice
hitting
on
a
the
golf
green.
ball this morning.
Spent a lot of time on the green, of course. Short game needs a lot of work. The
Okay.
putting game, anyway. They say when doing any sort of research to understand your client, it's all about understanding your client better. So I thought, what better place than to understand more about retirees than go to the golf course? And like, this isn't cliche. It was legitimately. I think we were the only two that were going to work after we finished our round. People were either having an 11 o'clock drink, or they were playing another 18 after they finished 18. So definitely, and I kind of see it. Like, it's a great walk. The weather's quite good. It's it's a bit peaceful, even if you're not good at golf like me. You get hit enough shots to be happy and have something to talk about for the next week. So it's enjoyable.
It's not
morning.
bad sport, is it? It is not bad.
Maybe the Australian Retirement Podcast reviews public golf courses. That might be a way to go.
Yeah, actually, that's a shout. For to all listeners out there, if you've got a good public golf course, we would love to hear about it. Don't tell us that Moona Links or Barnbougle is a good course. We know that already. Tell us something that we don't know. Give us, we'd love to get your feedback.
Something fresh.
We got heaps and heaps to get through today, but before this chat, you were ribbing me a little bit about a bet that we have taken that, oh my Lord, it's turned bad for me. I'm not sure how to get out of this.
I don't often get these right either. If you're watching along on the Australian Investors Podcast as well, we've got a portfolio, hypothetical portfolio, not an actual portfolio of investments. And I've just gone from last to first pretty quickly in that one. Just that, patience halfway through the year. I'm feeling pretty good now. But CBA. Personally, I didn't expect this. Like, I'll say, I was very confident that CBA, I'm pretty sure I said it'd be up 5% for the year, and you said 0. But where's it sitting at the moment? I can't quite remember. It's kind of a bit past me.
About it. Yeah, it's about 17.5% up. Add dividend, just a little bit more.
Yeah, and it's now a $300 billion company.
Yeah, that's right.
In a short space of time.
I read a piece in the AFR, not trying to downplay your bet. Well played, sir. You obviously understand the markets better than me. I read a piece in the AFR that was saying that if CBA is priced on future earnings, which is the way that a lot of companies, particularly in the tech space, are priced, it's more expensive than all of the Magnificent Seven. Magnificent Seven are priced on a big multiple of price per earnings, but then when you provision for where they expect their earnings to be in 3 years, like their own internal declaration of where we think it's going to be, then that multiple is a little bit more attractive. But CBA still has a pretty subdued earnings multiple.
That's still not that bad.
Of growth, and it's and they're still trading at an enormous PE. So
it is interesting because you could go on to, not that you use ChatGPT, but you could go onto ChatGPT and get all these comparisons. You can compare CBA to anything, but companies operate in their own ecosystem. Like, one, CBA is, I'd say, 3, 4, 5 times better than most of the other banks in terms of efficiency, in terms of their customer base. The amount of loyalty the bank has, you can't measure that in a price earnings multiple much of the time.
That's the Doommites program at work, mate.
Exactly. Everyone's stuck in there. I think it's not allowed. Are they still allowed to do that? And then you've got these other underlying trends that are pushing it further. So the broader adoption of passive management. So broader adoption of index tracking by large super funds, large industries. If people find Australia attractive or the Australian dollar is cheaper and they're buying more Aussie assets, well, naturally they're going to gravitate to the index, and that's going to have the biggest holding in CBA. And the same as the passive investment and the kind of micro investing that's happening, where people are reinvesting small amounts. A lot of that's going into VAS, or it's going into IOZ, the two
indirectly 10%.
ASX, and then you're getting 12%. So it's kind of got this little backstop. Hopefully it protects me for the second half of the year, because there's I'll say it now that CBA will fall from at least 10% from this point at some point this year. It's just history. I don't have to predict that. Like, it's just literally just history.
I'm glad that you at least softened the tailing, because at the beginning of that speech you had, I thought I was reading a hot copper thread. It was, geez, that was bullish. But yeah, it is. I agree with all of your sentiment. I think this speaks. We've spoken before about, for example, the way that superannuation funds are now ranked and how important it is that you're not bottom quartile every year. And what that has done, amongst other things, is it's pushed even more so that index management with a higher focus on being in ideally the ASX 300 and the top tier of it, because you don't want to be wrong as a super fund anymore. They've got billions and billions and billions of dollars to invest, and they can't afford to be wrong in that bottom quartile, or they'll lose so many members. So unfortunately, it creates an environment where there's just a tremendous amount of conservatism with regard to investment from super funds, and almost all of their stuff is in the large caps, is in the ASX 200 or 50, and then beyond that, the ASX 300. Fund managers, especially small fund managers, have more recently said it's super difficult to be winning business now, because everyone just wants to play safe in the large cap space and just say, if it goes up, it goes up. If it goes down, it goes down. But at least we know that if our platform, like if our investment is going down, so is everyone else's.
And I feel like that's a detriment to retirees too. Like, it's this narrowing of investments that are going directly into index funds, which are going to give you the average market return, or just in the index, even if they build it themselves, which gives you yes, it might be lower cost and it might be performing more in line with your competitors, but it just becomes a game of relative returns, where, like, what happens in retirement is you need absolute returns. You don't want relative. If it's -30 and you do -28, well, you've still lost 28% of your capital. In retirement, it just doesn't compute. There you go. There's probably a little zeitgeist reference there as well. But this like focus on relative returns that's come with how much size they've gotten I think it's made it increasingly difficult. And we actually saw that there was an announcement in mid-June that talked about from ASIC, that talked heavily about the increasing focus on industry super funds as well.
Yeah, agreed on all fronts. I'm the same. I think that if you're, I don't want a heap of super funds that all have exactly the same returns. I don't want a heap of investment options that all primarily do the same thing. One of the wonderful things that you want almost always is diversity of thought, diversity of application, and of course that flows into diversity of investment return. Yes, it means for the average consumer that if you want to step away from the beaten track, so to speak, then you have to have a high degree of conviction to do it. But the fact that super funds don't really offer, or like large super funds don't even offer a beaten track anymore, is a problem. Now, before we move on, you were talking, I mentioned before, the Doommites program. I've got to pipe in here because I saw an unbelievable graph quite a few years ago, but it's burned onto my brain. And it was this was back in my years when I worked at the CBA, and I was talking with someone who was the banking specialist for that program, the Doommites program.
Yeah. Very rich person.
No, well, I think she was just an
There's no
employee of the
commission.
Commonwealth Bank. But if she had any Commonwealth Bank shares and she's held them, then yes, she is now very rich. And she, we were talking about, there was this graph that was talking about Australians ranked by main financial institution. And what was amazing about it is that for Australians under 18, their main banking institution, main financial institution, was the Commonwealth Bank about 50% of the time, a really high number. And then for 25 to 30-year-olds, that number went down, but only a little bit, only to sort of 40% or thereabouts. By the time you got all out to the other end for a 60-year-old, it had evened up quite evenly. In fact, less people were banking with the CBA. There was, at the time, I think NAB was, and maybe Westpac also, had more market share than the CBA at age 60. But CBA just had this enormous advantage that had come on the front of the Doomite program, because so many young Australians, also me too, when I started work,
CBA account,
I had a Commonwealth Bank account, so I went to the Commonwealth Bank. When I took out my first home loan, admittedly, I worked at the Commonwealth Bank at the time, but that's a natural place that you go. So yeah, they did pretty well. Let's keep moving, if I may.
Well.
We are going to move across to the all-important. I love the fact that you've titled it this way. The all-important Boomer Briefing, and
also known as shaking your fist at the cloud.
Yeah. What's captured your attention this week? So, mate, for you, what's been the thing that stood out for you?
I have to put this the right way, because I don't want it to sound like I'm on my soapbox complaining about something. But I think it I mean, the best way to describe this, and we have meetings with a lot of people, ongoing existing clients, people, new clients, and there's people that have known us for 20 years and written every single thing we've written over that, read every single thing we've written over that period. So I had the fun of going to a lunch this week, and I was provided with articles of our investment approach and our views of 20 years ago. And I think rather than I can go into a little bit of detail on this, and this is someone who was a DIY, thought they could do it themselves, wanted to outsource, but never really let go when they outsource. So it's always been this kind of friction in that relationship. I think that's an important discussion when if you're looking for financial advice is, you have to be willing to outsource. Advisors will the role of advisors is to execute and advise and do all these things for you. And yes, friction is good and questioning is good, but not to the complete point. And that's not the message. That's just my side message. The main one is that how much and how important it is that investments and approaches evolve with the chimes and the circumstances. So we talked about things. This is getting very investment focused, but historically, financial planners, and we were the same, were very reliant on actively managed funds. Like most portfolios were either actively managed direct stock portfolios, or they were, Platinum, Magellan, all these companies made their billions off financial planners recommending them back in the 2000s. So almost every portfolio, you barely see a Vanguard or an iShares in a portfolio. I don't think iShares barely even launched back then. And it was this kind of evolution where, I'm not sure about yourself, but ETFs, index funds, low cost is now at the center of a lot of what we do, and it's about blending things around that. So, rather than go through all the complaints and challenges I went through, not that they were complaints, but more to understand how when you look and reflect on these things closely, it is important to evolve and rethink the way you're doing it, not just assuming that the status quo will continue working forever.
Yeah, agreed. I think that's a really fair thing to say. And I think that that's the time's in. I'm going to change my my boomer briefing point because it's all because I can change it also to add to that, which is that you're talking about outsourcing. When you work with a financial advisor, if you're listening to this podcast, there's a very good chance that your financial literacy is above the normal benchmark of your average Australian, and that's because you're proactive about your finances and wanting to educate yourself. So to all of you great humans out there, well done. But you also, above and beyond the knowledge, you also need to be able to execute really well.
Yeah.
And you also need to make sure that there are no obvious roadblocks getting in the way. I had a really interesting meeting yesterday with a prospect. We had an initial chat. Ideal member in all of the basic sense. Professional couple, working hard, 2 children. They're looking at doing everything they can to set themselves up for an early retirement. And the initial chat we had was really positive. No problem. Let's have that, like as in the initial phone call. Let's have a complimentary hour together and let's get granular about what working together might look like and all those sorts of things. And as we had this conversation, I realized, wow, you know heaps about your finances. Your financial literacy is huge. Really, really switched on about all of the rules around investments, all the rules around superannuation, all the tax rules. Fantastic. I asked how this came, and his wife laughed and said he listens to 8 to 10 hours of financial podcasts a week. Okay, that's pretty impressive.
Yeah. It's more than me.
I made the joke that my wife wouldn't listen to 8 to 10 hours of my stuff, no matter what you paid her. But she, this is just amazing. It's so cool to have people coming through whose literacy is at that level where you say, well, we've contributed to that and they've invested and got themselves into that position. But I did what you would probably do here when you have this conversation with someone that comes in with really high financial literacy and a good sense of knowledge, which is to get a sense for how well you're executing. Yeah. For every one person or every 10 people that come through and say, I know heaps about finances because I'm in the finance profession, or alternatively,
super dangerous.
Yeah, but great. But you've got to also be executing consistently, and you've got to be applying that knowledge really well. And often that holds people up for a whole host of reasons. But it turned out they were executing really well. We spoke then about, from a relationship perspective, do they both see things the same way? Was there any tension there? Nope, we're good. And I had a laugh with them that this is an ideal member on paper in terms of their ideal prospect. And I don't think we can help them. I think that if they were to come through and work with us, they probably wouldn't get value from the fees that they'd be paying, simply because all of the low hanging fruit in their finances is predominantly all looked after, and looked after well. And I had a chuckle about that. And again, at the end of the call, I was reflecting on it, and I thought, it's pretty bloody cool. It's pretty awesome that now we have a world where Australians can lean into their finances without the support of an advisor. Obviously, we want people to see an advisor, but the idea that information is now available to the extent where people can develop a really strong sense for their finances and not necessarily need one.
Is it weird that feels good? It felt good, didn't it?
Oh, it felt so good. Yeah.
Is it weird that it feels so good? We've done that. I did that 3 times in a day. Someone had a defined benefit, was more than enough they'd ever need, and all they had to do is accept the defined benefit. And we're like, I can't charge an SOA. There's no value in that. I'll tell you generally, this is what you do. I maybe look at this life expectancy calculator, and it was like, oh my God, it feels really good not to give advice. It's kind of, gone are the days where you're trying to, sell basically, or get people to take on SOAs that don't need them.
Yeah, I couldn't agree more. I think it's that concept of having a scarcity mindset around it, and saying, there's so many Australians in need of financial advice, and there's lots of opportunities to help people. So when we do come across someone that it's like, wow, you're at a point where you don't need help, for all the right reasons, that's pretty cool.
Yeah, it's amazing. There's probably another one that, when you're talking about that execution as well, this is where I kind of suck in, where people are self-directed. They think, they've had the benefit of a 5-10 year bull market tailwind, and everyone thinks they're doing it incredibly well. And you get comments like, oh, I don't want quarterly. Can you just do it once a year? Like, you kind of get these making it up as they go along. And it's like, no, there's a reason we do quarterlies. There's a reason we do 6 monthlies. These are built into the entire framework. And that's where the value comes from, in the consistent execution, as opposed to the ad hoc changes that tend to occur. I find that, and that's kind of a continuation of what you're talking about, which is always, super interesting to go through that conversation.
Yeah, I couldn't agree more. There's for every one dream that's killed due to poor execution, there's 50 that are killed due to nil execution.
Exactly.
And every person listening to this show I'd imagine, can reflect on a point in their life where they were looking to make a financial decision and either ultimately didn't do it. Like, we were looking at buying an investment property, we were looking at renovating, we were looking at upgrading the home, but it wasn't so much necessarily that we made a really conscious decision, or I made a really conscious decision not to do it. It's more so that we just kind of got tired in that search, and we just never went ahead with it. That's human beings. We all get busy in our lives. We all find it hard to execute. So yeah, I think that's normal. Now we have to keep moving. It's time for us to move across to our big question. And we had a ripper question here, very timely, which is, what are the things that, actually, I want to make sure I get this right. What are the biggest traps that might apply as I approach the end of financial year?
And I think it's important. Yeah. And I think it's important here that you, like, the mistakes can apply out at other times other than the end of financial year. And we do put a lot of urgency. As soon as there's a cutoff, like 25, 26 June, everyone starts to rush. And when you rush, you start to make mistakes. And I think we've got a few to go through here. Hopefully we get through to all of them. But I've found that one of the biggest ones, and this advisors like this, I've seen a lot of advisors get this wrong too when we find new clients, is failing to lodge a notice of intent to claim, which is when you do a concessional contribution from not from salary sacrifice or super guarantee, you actually have to tell your super fund that you're claiming a tax deduction on that. Then you have to provide that notice to your accountant to claim the tax deduction. And the trick here is, if you're doing a rollover, or if you're commencing a pension, or if you're lodging a previous year's tax return, the following year's tax return, you actually have to have done your notice of intent to claim before then. If you do a rollover, that's gone. That tax deduction's gone. You'll be paying more tax than you should have, and that can be a huge mistake. We kind of see it happening all too often. We kind of sometimes you catch it at the end when you happen to see what someone had done something. You can manage to fix it.
Yeah, to add to that, I've seen people get trapped out too with really high insurance premiums.
Yeah.
Let's imagine, for example, you've got a very small amount in super, and you decide to put in, like, you might have 50 grand in there, and you decide to put in a big contribution, $30,000 for this year. It's going to make sense. Your balance goes to 80, but then your insurance policy charges $5,000. Well, that's 6% of the overall account balance. If it comes out of your super fund, then technically what's happening is that there is a rollover happening from the insurance company's super fund, for simplicity, and your money's rolling from super fund A, your current one, into their super fund B, and then the debit is being taken from there. And the consequence of that is if you haven't done the notice of intent before that rollover is facilitated, then you end up with when you go to claim, they say, yeah, thanks. Well, you can't claim 100% of your 30,000. You can only claim 100% minus the 6% balance that got rolled out. So that's, that's a smaller figure, like 20.
And that's a direct tax hit. That's one that I think we always need to, that's one I drill into our team, and which we're constantly talking about. Massive risk there.
Agreed.
Thanks for watching this episode of the Australian Retirement Podcast. I'm Owen Rask, the founder of the Rask Group and Chief Financial Officer of Rask Invest. One of the great things about retirement is you get to switch off your active income and move into a mode where you rely on passive income from your investments. This can be a daunting time for a lot of people. In fact, most people in our community will seek financial advice at this time in their lives. So if you're watching the Australian Retirement Podcast, you should know that we have resources to help you find a qualified and vetted financial advisor. To get in touch with one of our financial advisors or partner advisors, you can head to the YouTube description that's below the video and simply click the link to get taken to a page where you'll find lots of resources for finding a financial planner. We've even created a matching tool which matches you to an advisor that we think may be suitable for your stage of life, your assets, or your goals. And you can also find resources on how to verify financial planners and their qualifications. It's all available in the link in your YouTube description. Let's get back to the show.
The next one we've got here, I think, is not accounting for salary sacrifice or higher SG contributions. If you are making voluntary contributions in a super, then power to you. That obviously speaks to being in a good enough financial position to being able to afford that. And of course, the tax benefits for most people are meaningful enough to do it. But make sure you get the calculation right. And how often have you met with someone that says, "Oh yeah, I put too much in that year because I miscalculated."
And go look at the public service here. So like universities teach it, like all those kind of public sector careers and professionals, they can get contributions that are higher than the super guarantee 12%. And if they're a bit lumpy, well, you could in some cases I've seen people go over the $30,000 cap with contributions they can't control, which then puts them into non-concessional, excess non-concessional, because they're already over the $1.9 million cap, or they've got a defined benefit. And it just becomes this rolling, I'd love to use a different word, but like this rolling, garbage bin of notice, like of having to log into MyGov and request for withdrawals of your super fund each year. Or if you accidentally make another contribution, like this is, check your contribution caps. If you've got an advisor, get your advisor to call them, make sure you're getting it down to the detail before you make any top up contributions at the end of the year.
Well done. Now, while we're here, we should talk about carry forward concessional contributions. Let's not do this in much detail. We have many times spoken about this on the podcast. So just if you Google it or open up the Rask website, you can find episodes where we've gone into carry forward concessionals in a lot of detail, or catch ups, I beg your pardon. But the reason why this is particularly important is there are going to be some Australians this financial year whose balance tips over the $500,000 number. So you might have started the year with $450,000 between contributions and growth. You've ended up with $510,000. And that means that there's a very reasonable chance that you'll never again qualify to be able to use carry forward or catch up concessional contributions. So with that in mind, if your balance is close to 500K, and it was below 500K as of 1 July last financial year, this could be the final window for you to make those additional contributions and get that additional tax deduction. Now, for some advanced financial planning, we've got a member right now who has a balance a little bit above 500K, but we also know that next financial year, they're going to have a big tax event. They're going to sell an investment property. The tax is going to be meaningful. And they're in this unique situation where they meet a condition of release. They can actually get money out of their super right now. And so what we're looking at doing is getting money out of super before 30 June to the extent whereby their balance will once again be below 500K.
On 1
so
July,
that next financial year, they've got the ability to make carry forward contributions, or catch ups. So with that in mind,
save them tens of thousands of dollars in tax probably.
Yeah. It's probably going to be about 45K, somewhere in that sort of zone of tax. So that's advanced financial planning. You definitely get advice for that, but noting that if you're in the realms of either wanting to do catch ups in the future, or alternatively you're mighty close to 500K, just check again before you get to the end of the financial year, because some doors might be shutting that you don't necessarily realize are closed.
Yeah, exactly. And I think and this comes down to compliance too, doesn't it? So the next one worth touching on is pensions. So there's no problem if you're in an industry fund or a super trustee, but if you're in a self-managed super fund, you need to make sure you're getting your minimum pension done appropriately and drawing the right amount. So I think one of the tricks here is that it's actually charged or calculated per pension account, and it is on your age as of 1 July in the previous year. We always get quite a few questions around this. So that's your 4, 5, 6, 7, 9, 11, 14% drawdowns calculated on your age at 1 July the previous year, but rounded to the nearest 10, of course, when you calculate it. And if you've got 6 pension accounts, like if you've made additional contributions and commenced new pensions, you have to calculate on each, not as the total, not as the sum, because it actually can result in quite a different figure. And that's forgotten all too often. And you can lead that on to probably another big one is not commencing a pension at all. Like if you're thinking about doing things at the end of financial year, you should be, and you haven't started a pension, an account-based pension, a retirement income stream, as I'm calling them, retirement pension. Now's a good time to be thinking about it. It's the potential tax saving is massive if you've met a condition of release.
Agreed. Yeah, and also noting that if you start a pension now in June, then you don't have to worry about minimum withdrawals.
Exactly.
If you started on the 25th of May, then you absolutely would.
Yeah.
Let's keep moving. You were talking about unlisted assets and getting those valued. Can you speak to those, please?
I'm seeing, and this is kind of an overflow of previous years. This goes back to the kind of not necessarily high net worth, but anyone holding residential property or unlisted companies or just unlisted property. Generally, it's property in your super fund, commercial property that you're leasing to yourself, and we know it's going to come even harder with the proposed introduction of Div 296. But what I always see is that we're lodging a tax return for the previous financial year, and we're now looking for valuations for this is some clients. Not there's a lot of examples of it. I think we've only 1 or 2 in the people we work with. But you're now looking to get valuations for properties, which is so far behind the 8 ball. So what you should be doing, if you do have residential property or unlisted assets, you're going to have to get them valued. So be proactive. Do it now rather than waiting until you're trying to lodge your tax return for your self-managed super fund later in the year.
Well said.
Yeah, waiting too
long.
While we're
let's move across to pensions. We talked before about pension payments, but one thing that we should be thinking about from a timing perspective is the fact that the transfer balance cap is changing as at 1 July, right? So what that means is if you're looking at setting up a pension in FY25 and you're weighing up the difference, if your balance is anywhere near that 2 mil, and particularly if there's any possibility of it getting bigger in the future, then it might be wise to wait the extra little bit until 1 July 2025. Of course, that's just this year, but the fundamental applies to any year. Do consider, if your super balance is high, that opening the pension next financial year might actually give a superior outcome, because that enables a higher transfer balance cap, which means you can put more money into the pension phase, which is hopefully tax-free. But that's not in my hands anymore. That's with Elbow.
Exactly. We're going to leave. We can't comment too much on that one. And that, the commencement of a pension, it also kind of brings me into something that all people tend to get wrong as well, which is misunderstanding the conditions of release. Like technically there's 3 retirement ages in Australia, but then technically there's none.
It's very profound, mate.
Well, you can retire whenever you want. Like there's no rule around when you can retire, but there's 3 ages that matter in Australia. So 60 is the first age, the basic preservation age. If you stop work after that, you can access your superannuation. 65, you could keep working and access your super, and 67 is when you start being eligible for the age pension. So there's 3 ages to think about. But I think what is often misunderstood is that if you draw a pension at 60, and you're still working, you don't get the tax benefit that you get from stop working or reaching 65. So, and also, historically, you could actually get access to your super from 55, depending on when you were born, which has all disappeared now. So I think misunderstanding those conditions of release can be incredibly penalizing or expensive if you get it wrong. And you got another one to turn around. I think it's very much tax driven. I think, and that's important. It's that time of year where that's what we're all thinking about.
Well, let's keep going from a tax perspective. Then one of the ones that stands out to me is not necessarily before the end of the financial year, but it is the day after that, which is getting your tax return completed. The number of Australians that leave money with the ATO for an extended period of time instead of just knocking over their tax.
If you're paying tax, take your time.
Is yeah. If you're paying tax, wait all the way till May the 15th. Power to you. But if you're not, if the house rule when you complete a tax return is ordinarily you're getting a refund, let's get the money in our own pockets versus leaving it in the ATOs. They're not paying you any interest for that money that is sitting there.
Sure, we'll charge you for it.
Yeah, they definitely will. Yeah, GICS, huh? So, so the approach here clearly would be if typically you have got a refund, and assuming that you've got everything that you need. We note that some, for example, some investment funds, some managed funds can take some time to give their financial year wrap up to the point where you can say, I've got everything I need. Sometimes that's as late as September, early October, which can be frustrating for some. But if you don't have those sorts of delays and on July 1, you've largely got everything that you need in order to get started, then get in touch with your accountant and say, hey, would rather have the money in my pocket than the ATOs. Let's get my tax return knocked over. What's more, my experience is, I welcome your comments here, but it's just so much fresher in your mind. Like, have you had the experience of doing a tax return, the follow like an FY25 tax return in March 2026? I can't even remember what happened last financial year. And so, what about this? What happened here? And it's like, oh my goodness, I don't know.
I'm the worst.
I'll scour my emails and work it out. So just it's fresh in mind. It's so much easier. It's so much quicker. Just get it done.
Yeah, even I'll be doing that this year as well. Like usually it takes time, as you probably do, you've got trusts or you've got company, like it can be quite messy, and every good intentions can drag out because there tends to be complexity when you run your own business. But I think I'll be starting much earlier than usual this year, just trying to get into, good tax hygiene, let's call it. And be, ahead of the game rather than you start to get that pressure at the end of the financial year.
Agreed. Yep. Now, lastly, while we're on the topic of business owners, I got a fantastic email from my accountant this week, and it said, hey, just confirming in line with our conversations for FY25, here's where everything looks. It looks like this and this and this, and here's what the tax position is likely to be, and so here's what you can expect through family trust, company, individuals, that sort of stuff. Brilliant. Thank you so much. And that happened because we have this proactive meeting toward the end of the financial year, every financial year, where we talk about how can we get our tax down and what are our plans more broadly and what do we need income to be if we were going to borrow money for an investment property or any of that sort of noise. So with that in mind, if you have a business, I mean, frankly, even for an individual, if you've got any complexity to your tax, being in the habit of having that proactive meeting with an accountant as you get toward the end of the financial year, for me, it's worth thousands and thousands of dollars.
Yeah, for sure.
So if you're not doing that, do. And if it doesn't, if
get
your
a new
accountant's not
accountant.
offering that, get a new accountant. Yeah, correct.
It is hard because that's like management accounting, where you're looking forward, where most accountants are built to look backwards. Calculate what you did last year and move on. But it definitely needs a more management-based accounting if you're running a business, for sure.
Yeah. Well, there you have it, everyone.
Yep.
They are the main things for you to knock over as you get closer to 30 June. We'll make sure that this one is published quickly and in your ears as soon as possible so that you can get some value. No point this one rolling out on the 25th of July. But thank you again for your time, and thank you for dialing into the podcast. Once again, if you have questions, if you've got those curly things that you want to clarify, there's two ways that you can get those resolved that are better than Google. The first option is to submit a question via the Rask website. You can ask a question that relates to your situation specifically. Feel free to get as granular as you want. We'll sanitize it and make sure we don't talk about Paula Smith down in Heidelberg, whose situation looks exactly like this. But then also you can jump onto the Rask forum. It's free. You can log in. You can become a member of the community. You can ask brilliant questions there. And as we've talked about before, you've got this fantastic level of community engagement where Raskies, just like you, are helping one another to be in a better financial position.
Amazing.
Thank you, everyone. Happy Thursday, and we will chat to you soon.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.